Well, all right. Well, welcome everyone to another Monthly on Monday. It's my pleasure to introduce today's speaker, Professor David Brownstone, who's Emeritus Professor of Economics at UC Irvine. Dr. Brownstone has had a distinguished career in economics, econometrics, discrete choice modeling, transportation economics, and applied economic methods. And we can maybe quiz him about some of that later after he tells us how to retire fruitfully. Beyond his research contributions, he's taken a key leadership role within the UC system. Most notably, he served as chair of the UC Academic Senate Task Force on Investment and Retirement from 2017 to 2023, where he helped guide UC's pension and retirement policy analysis for faculty and staff. During his time at the task force, Professor Brownstone helped develop retirement plan choice models to assist new employees in evaluating their options, and he's engaged in high-level consultations with system-wide HR and Senate leadership. He continues to be a respected voice on faculty welfare, retirement policy, and long-term economic well-being of UC's academic community. So please join me in welcoming Professor Brownstone, and I'm really excited to hear more about, which Bitcoins I should be investing in. So without further ado, we can do a screen share.
Okay, I will go ahead and start. There we go.
You can feel free to ask questions in the chat, and Dr. Parekh or I will relay them to Dr. Brownstone as they come in.
Well, thank you very much for that great introduction, Brian. I sound better than I am. I should say that I'm still on this task force. If once you retire from UC, you don't retire from the academic senate necessarily, so that's useful. And I've also been put on these other things, the UC Emeriti Association Joint Benefits Committee. That meets, we put out a report every 6 months about basically retirement benefits. And there's also this UC Emeriti and Retiree Advisory Council, where we meet quarterly with the leadership of UC Human Resources. Um, I'm actually on pretty good terms with the folks at Human Resources, except Cheryl Lloyd has announced her retirement, and hopefully they will not bring in someone from the outside. One of the reasons why UC retirement system works so well is that it also applies to the top brass at UC. So they don't want to mess up our things too badly because it'll mess up their own benefits. Okay. So this is, I can copy a list of what Brian asked me to cover, and it's obviously more than I'm going to be able to cover. But let me just hit a couple of things I can do very quickly. So one is solvency and stability of the UC pension plan. Basically, it's not our problem, okay? It's the region's problem. And there's really no need to worry. And I'll make that clear as we go along. Um, the other thing I can give you a very quick answer to is further down. It says UC and federal retirement income integration, coordination with Social Security, Medicare, and whatnot. A lot of that you don't have much choice. So I have very little to say, other than you should probably delay taking Social Security until you're 70. But beyond that, when you retire, you have to go on Medicare. You have to pay Medicare Part B. There's no much choice. But there you do have a choice in what you do with your retirement savings. And I will argue later that you really should be moving as much as you can into Roth accounts. Okay, the other point, one of the other things that Brian asked me to talk about, was where you can go for help. Okay, so as you may know, UC contracts with Fidelity to run our retirement savings program. So they're the ones who run this net benefits website. That's where you can go to change and deal with your 403B, 457, DCP, all those accounts. Okay. As part of that agreement, they provide a set of advisors whose main role, not their only role, is to provide advice to UC employees. And that's free. You can make an appointment with them, meet one-on-one. They also run webinars. Generally, the ones I met with seem fine. However, they are incentivized to sell expensive fidelity management accounts. So what a managed account is for something like 1% of assets annually. So if you got $100,000 account, that means they're going to take, 1,000 each year from you. They will take care of everything. Choose the investments. When you get old enough that you need to take distributions, they'll deal with that. That's fine, but it's a lot of money. Okay. And the alternative is new. So RAS is the retirement, what is it? Administration Service Center that runs, these are the people who run the UC retirement program. They have recently, in the last year, hired about 10 retirement counselors. When they were first hired, I spent about 2 hours with them talking about some of the issues I'm going to talk about with you guys now. They're all certified financial planners, so which is the highest sort of level of certification. And they all have training on the details of the UC retirement plan. They really should be your first choice for advice. Okay. Their main role is to, advise people when they're nearing retirement. And if you try and get hold of them like March and April, because most people retire July 1, you're going to have trouble getting an appointment. If you make an appointment now, my guess is you'll get to be able to talk to them, in a few days. And they're quite good. Having said that, neither of these people are fiduciaries. So what a fiduciary is someone who by law has got to act in your best interest. Okay. But the RASC counselors have no obvious conflicts of interest, and fidelity people obviously do. I mean, they want your money in fidelity funds, not other funds. The RASC people don't care. More generally, most of you have probably gotten emails from official sounding people who send they'll give you retirement advice. Remember, our directory information, our emails are public. So anybody can set up shop and send, all or some subset of UC employees of a certain age, you know, emails saying, "Hey, call us. We'll help you with your pension." Um, or you can also go to outside advisors, banks, Chase, Bank of America, they all have them. All of these guys have incentives to get you to buy things that generate money for them. So that would be like my last choice for anyone to talk to. The
So
last
even if they're
thing,
fiduciaries, David, or is it only
most of
if
these guys are not fiduciaries.
okay.
And yeah, and the problem is even if they're fiduciaries, if they work for like Fisher Investments, for example, where they say they're all fiduciaries, they're still, and I don't know this for sure because I haven't really talked to them, but my guess is that I do know some who work for some of the big banks. They claim to be fiduciaries, but their incentives to get higher salaries and advancement within their firms depend on how much revenue they generate for the firm. And I think that's going to be true at all these places. Um, the one exception to that is historically been Vanguard. Vanguard is not a publicly traded company. It is mutually owned by the stockholders. And so they've always been sort of an odd man out. Now, initially, Vanguard was a very small firm, and this was viewed as kind of odd. I think it may be the biggest firm in terms of assets under management now. The people who founded Vanguard, in particular, John Bogle, passed away in 2019. Some of the other people who were heavily involved in it are also, retired or dead. So who knows how that's going to go. But historically, they've been unusual in that their incentives are different. It's not so much as opposed to Fidelity, which is, a publicly traded company. The last thing, I'm going to put this in red because it's really important. You should do basic estate planning and tax planning like now. Okay. Um, Having gone through a couple of cases where relatives and friends have passed away, some with good planning and some without, it makes a huge difference. Doesn't matter to you, you're dead, but for the people left behind, it's really important. And ARAG, which is the university's legal insurance that you have to pay for, but it's not very much. They provide this for UC employees, and generally, I found, I've used some of them, and they seem pretty good. So that's a good place to start. But that if you haven't already done that, do it like now because if you leave this talk and get run over by a bus, whoever is left could have a real mess if you haven't done this.
So could you just elaborate on that a little bit more for a minute? Is that you know, the average uh, clinician is not thinking estate planning probably, and so we might be thinking estate planning means making sure that your estate is well manicured and that the
Yeah.
gardeners are taking care of
All
the.
right.
What is estate planning?
All right. The first thing is there has to be you need a will. And the will needs to say who's gonna manage your affairs after you die. Is particularly critical if you have dependents and children and things of that sort. In some more complicated cases, or if you are fortunate to have a fairly large estate. So by estate, I mean basically your net worth. Okay. So, you might think, well, I don't have that much money. But, if you're sitting on a house in this area, it could be worth as much as $1 million. You've got a lot of money. So at that point, you might want to set up something called a trust. And these are more complicated documents and things that have some advantages. I am not an expert in this stuff, but the advantage of a trust over a will is if you have a will, you have to go through what's called probate. So if you die with a will, your executor, who is the person you have appointed in your will to take care of things, has got to go to court to get approval to sell your assets, distribute them to whoever you wanted them distributed to. Um, if you do a trust, the trust actually takes care of all that. You don't have to go through probate court. Having said that, I know people who've gone through probate court. It's for simple cases, it's not the end of the world. But what you don't want to do is, get run over by a bus and then your loved ones discover there's no will. Because then you are at the mercy of the court. And it could take literally years to sort that out. And in the meantime, anyone who's depending on your assets to live on could be in real trouble. So you don't want to do that.
All right, thank you for that. Very good advice.
Okay. Now it's going to get more into the economic stuff. And this is for those of you who've heard me talk before. This is kind of new. So I'm going to start since most of us are scientists, or I'll include clinicians in that for sure. Um, there's some. I'll start with there. This is one of the few cases in economics where we actually have a good theory, and it works. Okay, so let me explain the theory. The key result is that it's impossible to predict returns in asset markets. And the reason for that is pretty simple. Suppose you could. Suppose I knew that gold was going to drop 50% tomorrow. Okay. Well, I could trade on that and make money. I could sell gold short, lots of things I could do. That's called arbitrage. Okay. And that's fine, except if enough people do that, the price of gold is going to drop, right? It's the way it works. And once it does that, then there's no ability to make any money. Okay. And for things like the US stock exchange, this process is literally happening in less than a second. There are all these big firms, some you've heard of, like all the banks are in this, some you have not, big hedge funds. Some of these guys have paid a fortune to have their servers literally located within, 100 yards of the main computers running the stock exchanges with fiber optic cables and whatnot. So these things are programmed to spot anything that, particularly if you think of what the classic arbitrage is, let's say a share of Microsoft is for one moment is you could buy at the New York Stock Exchange for $100, but you could sell it at Chicago for 101. Okay, that looks like a sure dollar, except someone's going to do that in literally a split second. Okay, so. And and so that's it's really this arbitrage argument is very powerful. And this has been this theory, by the way, won a couple of people Nobel Prizes. So this is, this was not an obvious result, perhaps, but it's nevertheless true. But it people don't like it. So the obvious one is, if you might have heard Einstein's famous quote, God does not play dice with the universe. He was actually griping about statistical mechanics and quantum mechanics. Um, but Einstein was wrong, and the fact that people don't like it doesn't mean that it is wrong. The bigger problem, and this is really getting to sort of people's behavior, is particularly scientists, doctors, and people like me are trained to look for patterns. That's one of the key things we do. Um, But here, there are no patterns. So even though, but if you're trained to look for patterns, you're going to think, okay, there must be patterns there. And the problem here is that investment advisors, people selling assets, they prey on this. Okay, they claim, and maybe they themselves believe, that there is some hidden pattern that they can use to make you money. Those people are either corrupt and or they're fooling themselves and fooling you. The only thing is certain is that they are going to charge you very high fees for whatever it is they're doing. Um, so that's one implication, and it's an important implication. And let me push this a little bit further. So first, let's show you a picture, okay? I apologize for the bad colors here. I copied and pasted this from an Excel file where the colors were like, green and red and black so you could make them out. And somehow PowerPoint decided these colors were better. So what is this? Along the x-axis, I don't know if people could see my thing here, we go from 1928 to 2024. So this is the other thing that's different about this talk. I'm going to talk about long run stuff. Most people in finance, long run is 1 year. Well, if you're talking about saving for retirement, 30 years is more like a reasonable window. So the orange line with the big squiggles is the S&P 500. Actually, the S&P 500 is an index of the 500 top companies in the United States stock market. It only existed starting in 1957. Economic historians have put together something. Um, but in any case, you can see this moves around a lot. Okay, the yellow line, which is harder to see, is a 10-year Treasury bond. And the gray line, which doesn't move much at all, is a 3-month Treasury bill. So these Treasury bills are when you hear a finance person talk about cash, they usually mean Treasury bills. Okay, they are backed by the full faith and credit of the U.S. The market for them is huge. You can sell them anytime you want. However, they're not immune to inflation, and that's what's causing the squiggles. So you might, if you can barely see it here, but there's a big jump in the 3-month Treasury bills that occurred around 1980. Those of us who are older might remember that's about the time that the inflation took off. Reagan got elected, all sorts of things happened. I also point out some of the downturns here that are relevant. 1931, beginning of the Great Depression. Not sure what happened in 1937. Actually, World War II was okay. This drop here is in 1973, the Arab oil boycott. This one down here, 2000, was the dot-com crash, Great Recession, 2008. We lived through that. And this other dip down here at the end was COVID. Okay. However, I mean, so some of this makes sense. Things, if something really bad happens, unexpected, markets drop. But the point is, even at this scale, which is annual, you really cannot, there's no pattern here. You can fit any curve you want to this, and there are gonna be errors. Okay. Now, what's this got to do with anything? Okay, so first I want to talk a little bit. So the story here really is, if you believe this theory, is basically says that stock asset markets generally and in stock markets in particular are like a casino. The key difference between a casino and a stock market is that a casino, on average, you're going to lose. I think everyone knows you go to Vegas and you sit down at a poker table or whatever, and you sit there long enough, they're going to take your money. It's the reverse in stock markets. And so, but there is a link here. So here's a little example that I hope will explain why this works. So suppose you have a fair die. So for those of you who don't play gambling, a die is a six-sided thing. A fair die means if you throw it up in the air, it's equally likely to land on any side. So the sides are labeled by numbers here, and the way to interpret this is you're going to put $1 bet on this thing, and you're going to get back either minus 25 cents, minus 12 cents, 0, 12, 25, or 40 cents. I cooked up the numbers so that the expected return, if you just keep doing this, is 6.67 cents, which is pretty close to the long run average return in the stock market of around 7%. Okay. So that's what happened. So this is what the theory says would happen for a particular stock. Okay. Now, what's an index fund? An index fund, instead of doing that, is going to invest 1 cent in 100 different stocks. Okay, so what's that like? Well, that's like you're going to throw this die 100 times. Well, you're still going to get the same 6.67 cents, but there's not going to be nearly as much variability. If I hold one stock, every year and I flip the die, I mean, if I'm unlucky, I could go bankrupt pretty quickly. Four rolls of minus 25, I've lost my dollar. Okay, if I do it, but the odds of that happening, if I've rolled it 100 times each year, are much, much lower. And this is the key feature behind diversification, which is the best way to deal with the huge amount of uncertainty that I showed you in that picture previously. Okay. Now, of course, in the real world, nothing's that simple. It's not like, not literally rolling dice or playing roulette or anything like that. Stock prices and firm values are going to vary quite a bit. So what index funds actually do is invest in each stock according to the market value of the underlying company. So you probably have all heard this. There's like, five or six big technology companies that dominate, the S&P 500. That's true. You've probably heard of them. They're NVIDIA, Microsoft, Google, Apple, those kinds of things. Okay. And that's fine. Um, But the key result, well, whether it's fine or not, we can talk about that later. But the key result here, which is the one I really want to hopefully convince you of, is that these value-weighted index funds, which is what I just described, are efficient. And what that means is, Any deviation that's going to increase your return is going to increase the risk more. Okay. So there's always going to be a trade-off between the riskiness of an investment and the return. And you can see that obviously back in this picture. Okay. The safe investment here is the gray line, or the safer investment. And clearly, in terms of variability, there's a lot less than what's going on with anything else. Okay. But the point here, in for what the efficient market says is, yeah, you can increase the return here, but at the cost of increasing the risk. Yeah, is there a question?
Oh, praat ik klaar? Of was het dit?
Or someone just needs to mute. I can't hear.
Baez, can you mute?
Oh, okay. Well, all right. All right. So this is kind of the key the key result here. If you buy into this and understand it, then finance is easy. But and just so that's the theory. What's the data? Well, it turns out that over 75% of actively managed funds underperform the S&P 500 index over any sort of 5 to 10 year interval or longer.
Can you
And
define an actively managed fund? Is it
yep,
apparently that's not these index?
anything
Um,
other than evaluated index fund. The extreme case is someone who says, hey, the world is all AI, and you can buy stock funds that only invest in AI stocks. That would be, and if you did that 2 years ago, you would be very happy. If you do it now, I suspect you won't be happy 2 years from now, but that's another. Okay. But anything, I mean, or for that matter, and this is another point I want to make, just investing in the US market also is a form of active management. Roughly 40% of the stock market in the world is outside of the US. So by only investing in the United States, you're actively assuming that the United States is always going to outperform the rest of the world. And that's certainly not been true for the last couple of years. It has been true over longer periods. But in any case, so anything other than anything other than and I should also be clear, I'm picking on the S&P 500 index because that's the only thing I could get data on going back to 1928. I personally do not invest anything in the S&P 500 index. I invest in much broader indices. And we'll talk about that in a way too. So there's two reasons why this is true. One, the theory is right. Okay, you can't beat it. So anything that deviates from it is on average not going to work. The other possibility is that the way investment managers are compensated. In almost every case, investment managers at mutual funds are compensated based on their annual returns. So they're chasing annual returns. Then that doesn't work over a 5 to 10 year period. Because remember, they're just the basic result says that they're no good at predicting. No one can predict. So they may get lucky 1 or 2 years, but you don't get lucky forever. And eventually they're going to be in trouble. So basically what they're doing is they're taking on additional risk to try and increase their returns. A more close to home example, turns out about 75% of university endowments also underperform the S&P 500.
oh, that's encouraging.
Yes. Well, I have pretty good data. And this was not easier to get, by the way. I had to go back and look at old Regents reports, but I put together the return of the UC pension investments from 1991 to 2024. Okay. Turns out they had an 8.3% annual return. Okay. So it turns out that if you look at an index portfolio that's 60% the S&P 500, 40% US bonds, it had an 8.7 for return with pretty much the same annual variability. So one takeaway from that, and I have occasionally, although not recently to his face, pointed out to the chief investment officer of the university that I would take half his $2 million salary and I could, match his performance. Um, that doesn't go over very well. Uh, but it's also important to note that the UC pension investment return is actually in the top 25% of its peers. So you can say, hey, this doesn't look so good, but there's a lot of people who do worse. And once again, the problem is the way things are compensated. Now, you see, at least we compensate people based on their 3-year returns. That's better than 1-year returns. All right. It's also the case that which is true of all of these guys, that there's a base salary and then they get a bonus. So they get a bonus if they beat their target. And if they miss the target, they don't get the bonus. So the incentives for them are really to essentially take more risk. Because if they luck out, they're going to get a big bonus. And if not, they still get their base salary. That's fine, but we could do a lot better. And we could get rid of I think the last time I checked, the budget for the UC investment office was about 40 or 50 million a year. I'm sure we could all think of something more useful to do with 40 or 50 million a year. The other thing I'll say is that the 60/40 portfolio is kind of a rule of thumb that people have used, and it actually satisfies what's called the 4% rule. And that says you can take out 4% of the portfolio after inflation without going bankrupt. And that is true for every year starting in 1928. So, okay. So, and that's a useful thing to know because one of the issues with retirement is, and people are Fidelity or anyone else goes great lengths to say, what you have to do to make sure that your money does lasts. And it's not that complicated. Okay. If you have at least 60% of the portfolio in equities, you can pretty reliably take out 4%. Now, the next question, which I will just jump ahead because people are going to ask me, well, no, I'll wait until someone asks. That's fine. Okay. All right, so a little bit more investment basics. I'm going to go quickly over this. So this nobody can beat the market is actually not my idea. A Random Walk Down Wall Street is a classic by Burton Malkiel. I will own up that Burton Malkiel hired me for my first job and taught me some of this stuff. He's a great guy. He's still kicking at 92 and still active. He was also one of the original board members of Vanguard. So, and as I've explained, the best way to deal with investment uncertainty is diversification. You definitely want the broadest base index fund you can get. And fortunately, as I will show you, I'll actually tell you there are some good funds in Fidelity for UC. The other important thing here, which I should have made in blue or red or something, is any investment that promises high returns is either very risky or a scam. Okay, and there are plenty of examples. The two that come to mind in the scam category are FTX. Everyone probably heard about that with Sam Bankman-Fried. Those of us who've been around a little bit longer may have heard of Bernie Madoff. That was one of the bigger Ponzi scheme scams. But Enron, there's a whole bunch of these things that if it's too good to be true, it is. Okay, so that's rule number two. There's a lot of broad-based mutual funds, and ETF stands for Exchange Traded Fund. I should have written that out. They're all good to the extent that they're broad-based. The theory says you're all going to get the same long-run return, right? If you can't predict returns, in fact, the Wall Street Journal used to run this game where they would uh, invite 10 investment professionals to choose a portfolio for the next year or 6 months, and then they take out a dart board, which was plastered with the list of all the firms on the New York Stock Exchange, have somebody throw 30 darts at it. The dartboard won like 80% of the time. Okay. So this is, but it didn't win by much sometimes, and that just proves the point I'm trying to make here. It doesn't really matter. What does matter is the fees. And one of the big advantages of staying within the UC retirement savings program is I will show you the fees are very low. And I will take some credit for that, and I'll give even more credit to Marco Mers, who is the person at UC Investments who is responsible for the retirement savings program and who really pushed pretty hard to do some pretty hard negotiations. If you talk to people at other universities or other firms, no one has fees as low as us. So this is one where UC has done a really good job. Um, the last thing, narrow specialized funds, like I mentioned, the AI fund or the biotech fund, you name it. Those are all attempts to beat the market. They will all fail sooner or later. Can't tell you when. What I will say for certain is they charge higher fees, and by higher fees, typically 10 times higher than the fees of the funds that I will tell you about. And depending on how much money you have, that can turn out to be a big deal.
Especially compounded over time.
For sure. Okay, now the other thing to learn here from this is, which is also important, is that the only assets that really have gotten much returns are equities and corporate bonds. Gold, treasury bills, residential real estate, all earn much less. So this first line here is tracking all of these things, and there's a source down here. If anyone, this is freely available. You could download the spreadsheet and play with it to your heart's content. So if you put $100 in 1928 in the S&P 500, you get about 1 million now. If you happen to put it in small stocks, in small stocks, by the way, is defined as the lower percent 10% of the distribution of value in the US market. Talked about treasury bills, BAA bonds, think of those as corporate bonds. Homes, we need to talk a little bit about. This is a index of the value of residential homes. It was put together by Bradley Schiller and Carl Case, two economists. It's turned into the Case-Shiller index. Um, it's it unlike what you normally see in the press that talk about the median home price, sales price. Problem with median sales prices is not the same home. This index is based on following homes through repeated sales, so it controls for the fact that homes are getting bigger and fancier. Um, Gold, as I mentioned before, this is everyone's flocking to gold now. And the other thing to recognize here is that inflation is important. So what this says, if you had $100 in 2028, that's worth 1,822 now. That means if you were a millionaire in 1928, you would need $1.8 billion to have the equivalent purchasing power. So overall, inflation has been running about 3% in the United States. Now, you've all, I'm sure, hopefully heard that the Federal Reserve, which supposedly is concerned about this, their target is 2%. And there was a period of time in the 2000s when we achieved that, but we really haven't. That's I'll jump ahead to say that's relevant to UC pension. The UC pensions are not fully indexed to inflation. As soon as inflation is over 2%, your pension is going to decline in value. So that's an important reason for looking at other investments. So Why are returns to homes so bad? Homes are just another asset. Now, one difference is that the calculations that Case and Schiller did do not include the fact that if you own a home, you have someplace to live. You don't have to pay rent. So that's good. More importantly, though, home prices are set by buyers who expect to get highly subsidized mortgage interest rates, like close to zero after tax, and they have the ability to borrow at least 80% of a home value. Okay. If someone took your diamond ring into the bank and said, "Hey, this is worth $10,000. I want to borrow 8,000," they'll laugh at you. You come to the bank with a home that's worth $1 million and you say you want a 800,000 loan, chances are, if your income is pretty good, you'll get it. Now, what does that do? This leads to what's called leverage, which is another key finance term. So the way this works, if you buy a home for 1 million and you only put 200,000 down and then sell the home after a year for 1.1 million, that's not unreasonable in the last few years. Your return is close to $100,000 or 50%. Right? Now, the problem with leverage is it works in both directions.
Well, that's inconvenient.
Yeah, very inconvenient. If you sold the home for 900,000, your return would be minus 50%. And if you sold it, for 800,000, you're wiped out. Your investment's wiped out. Leverage is really important because it amplifies both gains and losses. And if you're trying to figure out if someone's offering you some fancy investment product, and there are many exchange traded funds that do this, but certainly private equity, private credit, and hedge funds all use leverage, and they use a lot of it. And what that means is, so the easy way to increase the risk of any investment is just to leverage it. Okay, that just blows everything up. And particularly when interest rates are low, and they are for home buyers because of the huge mortgage interest deduction subsidy, um, and the fact that the government backstops these loans. But more generally, there was a period of time in the United States recently when interest rates were very low. That ended pretty rapidly a couple of years ago. But when interest rates are very low, people like to get into leveraging. And that's okay as long as you know what you're getting into. You're increasing both the risk and the return. Okay? Now, the other reason why homes don't work like stocks, remember, stock trading can literally happen in microseconds or even less. If you ever try to sell a home, it's slow and it's expensive. Frequently, 6 to 10% of the home's value gets chewed up in commissions and other expenses, title searches, all that stuff. And so prices adjust very slowly. So everybody knows that the price of homes in anywhere, in particular Orange County, is very high. Um, my guess is they will drop, but I can't tell you when. Takes a while. Okay. Now, so this is more relevant now to really retirement savings. So what I did here was I took each year starting from 1928 through 2005 and looked at the 20-year annualized return. Okay, so the last period goes from 2005 to 2024. The 1930 dot goes from 1930 to 1949, I guess, and so on and so forth. And what I'm showing you here is the link between return on the investment, which is the y-axis, and the horizontal axis is 20-year inflation. Right? This is funny little star thing you can see here is what UC assumes for investment return and long-term inflation. So this is getting back to the question that Brian asked originally, should we worry about, or how much should we worry about the solvency of the UC retirement pension investments? Well, what you'll note here is that this star is pretty conservative. Most of these dots are above it. Okay. Like roughly 75% of the dots actually are above it. And if you actually look at the returns that UC Investments has gotten over the last many years, it's usually more like 8%. If you go back to 1991, it's 8.3%, but if you can cut it different ways. And that's not so surprising because if you sort of look for the mean of this thing here, it's going to be, right around in here somewhere, around 8%, maybe a little bit more than 3% inflation. And so to the extent that UC is being conservative in their assumptions, which they are, that means that any investment surprises that occur are more likely to make the pension fund larger, not smaller. And so over time, any accounting liability, of which there is one currently, will go away. But this also gives you an idea of what's reasonable to expect. Okay? Um, and so something like, an 8%, 3%, 8% return, 3% inflation is something that you can expect to get over a fairly long time period. And for most people, if you're retiring at age 65, 20 to 30 years is about the window. Okay. Now, one of the things that Brian asked me is, how the retirement plan integrates with Fidelity. First thing is, I've talked about this 60% stocks, 40% bonds. It's important to realize that your pension and Social Security really are equivalent to a treasury bond. How so? They pay a fixed amount. There's really not much uncertainty in them. Treasury bonds are very safe. They're backed by the full faith and credit of the U.S. government, as is Social Security. The UC pension system, according to the lawyers on my task force, is backed by all the assets that UC owns. So if we sold the land under UCLA or Berkeley, that would be more than enough to cover any unfunded liabilities. And according to my lawyer friends, the current people who are earning pensions have the first claim on UC assets. So if UC went bankrupt after you retired, you could still assume you're going to get your pension. All right.
Or we should retire quick, right, David?
Well, that's the other
Make
possibility.
sure we're in the pool.
Uh, I really, but yes, you could say that, but I don't think that's really a problem. But the point here is that, so why do I say multiply by 25? Okay, suppose that your pension from UC will be 100,000 a year. Okay. If you multiply that by 25, you get $2.5 million. Right now, you could buy a treasury bond for $2.5 million that'll earn about 4%. And 4%, 2.5 million is 100,000. So that's why I came up with that value. The reason that's relevant is suppose I've convinced you that this 40-60 split is reasonable. But then the question is how do you value your pension and Social Security? And don't discount Social Security. For many people, it's going to be bigger than their UC pension. Okay. And so if you take this equivalence, most people are way over invested in bonds. And most people are way over invested in real estate if you own your own home, because that's an asset that earns very little. Right? So if you're going to get a pension, particularly if you've been around like Brian for a while, or even longer, like people like me, you're going to get a pretty big pension. You probably don't want any of your other savings in bonds because you've got the equivalent of a huge amount of money in bonds already. The good news is the UC retirement savings plan as I said, provides very low cost funds. So if you just buy what I said and you want to just put all your money in equity, I would highly recommend the UC Global Equity Index Fund. You can find that, just go to net benefits, poke around, you'll find it. The only reason you might not like it is it excludes fossil fuels, and so it's not a pure index fund. If you want purity, you can go with the Vanguard Total World Index Fund. It's an ETF. VT is the symbol. But Vanguard, which is historically among the lowest fee providers of mutual funds, they charge 0.06% annually for their fund. UC only charges 0.01%. And that's pretty typical. And very few people beat Vanguard's fees. The funds that UC runs do. Now, Fidelity is also going to tell you they've got a whole bunch of funds that they think are great, but they're going to charge a lot more than 0.06% for a worldwide fund. So this is a one size fits all. If you are not expecting to get a pension, so I don't know how many people on this call were hired after 2016. You do have a choice if you were hired after 2016, or if you think you're going to retire before you get much of a pension, maybe you don't qualify for Social Security. The default target date funds that we also offer are also fine, but they are way too conservative for all UC employees who are going to get a pension. So those are all good choices. I'm not sure why the UC Global Equity Index Fund has so few people in it, but that's okay. It's a good deal. Bonds. Okay, so I just told you you don't need bonds. But if you look, if you look at the data and you look at the graph long enough, you'll say, well, wait a minute, what happens if I need, money for sure in the next 5 or 10 years? Maybe your child's going to go to college. Maybe you're thinking of buying a home. God knows what. Okay. Well, then you probably don't want all of that money in the stock market because you saw the kind of variability. If a bad year hits, you could lose a fair amount. Uh, if it's a 5 to 10 year period, the UC Short-Term TIPS Fund, TIPS stands for Treasury Inflation Protected Securities. So these are government bonds, just like Treasury bonds, but unlike Treasury bonds, they pay an interest rate that's tied to inflation. So you get basically something like some part of the 3 month Treasury bill plus inflation. And so, as I mentioned before, inflation is something that's a real problem, particularly for UC pensioners. Social Security, by the way, is fully indexed for inflation. So that's good. You don't have to worry about it. Now, the problem with that is you can only get that fund in the UC retirement savings program. So if you're below 59 years, so that you can't easily take money out, uh, the UC short-term tips fund may not be so good. I mean, it's a safe investment for 5 or 10 years, but if you can't take the money out, it doesn't help in this case. Vanguard has one. It's called VTIP. It's widely available. Once again, the fees are higher. Vanguard charges 0.03 and UC charges 0.01. Okay. If you need the money in less than a year, like you think your car is about to die or something of that sort, you really should be in a money market fund. Okay, and everybody offers money market funds. There's pretty much all the same. If you want long-term bonds, I'm arguing probably you don't, but if you do, anyway, the one I would recommend is the Vanguard Total Bond Fund ETF. What that does is and you can get these Vanguard funds through the Fidelity Net Benefits brokerage link at no additional charge if you want to do this inside your Fidelity account, UC Fidelity account. I should say a word here about the difference between a mutual fund and an ETF. So mutual funds are the old-fashioned approach where basically the index fund, for example, the Vanguard S&P 500 index fund for many, many years, they literally buy shares of every stock in the S&P 500 index. And if you buy into that fund, they will go purchase more shares. If you take money out of the fund, they're going to have to sell some of those shares. An exchange traded fund does the same thing, except they only issue one share of ETF is a fixed set of stocks. So if you want to sell, you have to sell to somebody else. If you want to buy, you have to buy from somebody else. So the advantage for that is going to come in a minute when we talk about taxes. Mutual funds, because they have to trade, generate taxes. Now, if you're inside, if you're in, doing this in your 403B or a Roth account, that's irrelevant. If you're doing this in a taxable account, it does matter. Um, so that's why most people prefer ETFs these days, particularly for taxable. Now, as I said, hopefully I've convinced you that personal finance is easy. Sort of. I'm actually running out of time here. I'm sorry. Well, I'll speed up a little bit. Taxes are hard, and this is important stuff. So dividends, which are payments from companies to you as a stockholder, they are taxed less than interest and regular income. All right. Capital gains are only taxed when you realize them. So if you buy a share of Microsoft, back in 1990 at $10 and now the equivalent share is $1,000, you don't have to pay capital gains tax until you sell it, and then you got to pay tax on $999. But the rates are generally less. More importantly, in terms of this is where estate planning rules come in. If you hold on to something till you die, then all the capital gains go away. Okay? And so this causes all sorts of problems. So, take an example, if you've got an elderly relative who's thinking about selling their house and you're going to inherit that house, there's a big advantage to you of waiting till they die in the house because then you don't have, then there's no capital gains on that house or their stock portfolio. However, inherited IRAs and 403Bs have to be distributed within 10 years of death, and they're taxed as regular income to non-spouse beneficiaries. In addition, those same things are subject to what are called requirement minimum distributions starting at age 73. That starts at about 4%. So Congress can and has changed this. I have a theory that I think hopefully convinced you explains what good finance is. I have no theory to really explain why the US chooses the tax rules we've got. Our tax rules are very peculiar relative to the rest of the world. They make no sense based on any economic theory of optimal taxation, but that's what we're stuck with. We are the only place in the world, I think, that has this step-up rule, which causes all sorts of fun things. So this leads to the last thing I probably going to have time for today, which is Roth versus tax deferred savings. So tax deferred savings are things like regular IRAs and 403Bs, where you don't pay tax on the money that goes into them. Roth contributions are the reverse. Okay, you pay tax and then after tax you put the money in. The difference is when you take it out. If you take money out of an IRA after age 59 and a half, it's taxed as regular income. Roth money distributions are not taxed at all after age 59 and a half, and there's other exemptions. Okay. Long story short is low wage and young employees should almost certainly save 100% in Roth accounts. Why is that? These tax deferred accounts are only good if you expect your tax rate to be lower in retirement. That's usually not the case. Most UC retirees that I know of find they actually have at least as much or more income now. Now, I realize in the medical school it's somewhat different because your pensions are based on your X and X prime. But nevertheless, if you do some numbers, I think you'll find that your income is not going to drop much, particularly if you stay here till you're 65. There is a Depending on your situation, it may make sense to convert your existing pre-tax balances to Roth, but that's complicated. Okay, I'd be happy to talk about that if anyone wants later, but the Roth conversions require paying additional tax now. And the other thing I will say for sure is it only makes sense if you can afford to pay the extra tax from other funds. If you have to sell IRA funds and use the proceeds to pay the tax on the conversion, the math doesn't work out. So, but if you're in a fortunate situation when you can afford it, it probably makes sense to convert quite a bit. Okay,
So
so
when you say, David, that you would pay that through other funds, you mean other cash? Like you needed to have to
yes, so
sell.
you would have to have some other source of funds. So either you're not spending all your salary or you got some other savings, or maybe a rich uncle dies and leaves you some money, that kind of stuff. Okay, so briefly, yeah, employee investment advice. I think I've already said most of this. Delay taking Social Security until age 70. That gives you a sure 8% return. I said you can get an 8% return on average in the stock market, but it's certainly not for sure. So I think most people agree you should wait until age 70 if you can. Right? Also, because of taxes, if you things like bonds or stuff that generate regular taxable income should either be in a Roth account or at least a tax deferred account, because otherwise that's the tax part of it. Finally, I guess I'll end here. This is a good place. People are always worried, and I get this question all the time. They list people listen to Regents, you read articles in the paper. UC retirement plan, which is UCRP, is fine. We've got about 20% unfunded liability. That's about 20 or 30 billion dollars. That sounds like a lot of money. It really isn't, because first of all, it's the region's problem, not ours. They are legally bound to pay the pension. Right? They're making quite conservative assumptions. So unless the Jagdeep Bachelor, our chief investment officer, does something really stupid, he's going to do better than this, the 6.75%. What that means is that this unfunded liability is kind of going to disappear. The amount that we're already contributing to the pension system is sufficient to keep the thing even. Okay, it's the amount we're contributing is not going to get rid of the unfunded liability, but it's enough so that the unfunded liability won't increase. And the fact that we've got these conservative assumptions means that eventually this unfunded liability is going to go away. Now, that's the good news. The bad news is pension is guaranteed. Retiree health benefits are not. And you guys are the health experts. Unless something changes, costs keep going up. UC's revenues keep going down. Uh, Retiree health is always pretty high on the list of things to cut. It's also very likely that inflation is going to erode the value of a UC pension because of this cost of living adjustment. And the implication of that is that you want your investments to be in things that are likely to at least keep up with inflation. The key there is equities. Equities do quite well in inflation. And if you really want to put money in bonds, medium term, choose these inflation protected securities, because there at least you're guaranteed to not lose. Okay, I'm going to stop here because I run out of time.
All right. Well, Wow, my head's full, but if anybody has any questions, this is a good chance to have them answered.
I can hang around a bit if anyone has any questions.
We peaked at some 55 people, and we've lost to 10 or 11. So
Okay, well,
it
it's
was
getting
there
near
was
dinner time. I understand. And
indeed. But anybody have any questions? We have a an expert right in front of us. Oh, will we have a copy of the slides? So yes, the this presentation will be posted on um, the AP website in the near future, so you can watch the presentation again. David, will you share us the slides that you didn't present, so we can just post your slide deck online?
yeah, I gave the slide deck to Rachel, so she's welcome.
Great.
Yeah, I don't. This should be fine. There's some interesting stuff here about lump sum cash outs and for new hires, but they hopefully self-explanatory.
And David, we can bring you back for next year as Brian and I plan, so we can still finish up your slide set in 2026.
Okay. And I should also say if people run into trouble with any of this stuff, first people to reach out to are RASC. They're the experts. And if you run into trouble with RASC, as long as I'm still on all these advisory boards and everything, shoot me an email. I know the people to yell and scream at, and for the moment they still listen to me. So
All right. Well, thank you. As many people in the chat said, thank you. They want to see the lump sum information as well. Rachel's posted where the Monthly on Monday series can be found. So I want to join our audience in thanking Dr. Brownstone for a great presentation. I really appreciate it.
it was my pleasure, and I'm glad to see a fair number of doctors who I actually know here. Yeah.
Well, thank you for helping them. So
Okay.
we appreciate it.
Bye, everyone. We'll see you next month.
Okay.